Hello guys, this is CA Vishal Jain, your faculty for CFR and SBR paper. Guys, I know that you guys already know the concepts of group accounting, but when it comes to presenting your knowledge as part of section C, when it comes to preparing group SOFP or group P and L, it is there you guys struggle. So what I'm doing is I'm taking the revision of group SOFP in the most exam oriented manner. So what I will be doing is, first of all, I have written the steps of preparation of console SOFP. Now see the adjustments. So each and every adjustment, like exactly how you have to do in the exam, okay, the adjustments. So I will be doing it. So and what I'll do is, what I have done before taking up this revision is I have went through all the adjustments of group accounting that has come up in the exam, BPP, Kaplan Study Hub, any kit, or whatever was there, I have went through all the adjustments, and I can assure you that each and every adjustment will be covered as part of this revision of console SOFP. Okay, now this console SOFP revision will be divided into four parts. First part will be for console SOFP. Second part will be for console P&L. Third part will be for associates. And fourth part will be for group disposals, that is disposal of subsidiaries. Okay, today is the part 1 for console SOFP. Okay, the next part will be console P and L. I'll be uploading console P and L also. I'll be uploading part 3 also. I'll be uploading part 4 also. But I am giving you a target. Once this video reaches 2K views, then I will be uploading group P and L. Okay, so with each 2K views, I will be uploading the next part, and I am giving you a like target of 500 likes. 500 likes. Okay, now guys, all of you, after watching this session, if you enjoyed the session, see, it takes me considerable amount of effort to record these videos for you guys, for your benefit. So all I'm expecting is, give me something in return, give me in comments how you enjoyed the session, whether you liked it or not. Write in the comment box, okay, it will be a motivation for me as well. And also subscribe the channel. Now start the revision of console SOFP. So let's revise console SOFP in this Excel file to understand exact how and where things should be presented. But before that, what we'll do is we'll take a holistic view of the things, of how exactly the steps will move for group accounting. So we'll see a helicopter view of the process of the you can say console SOFP, and then we'll dig into the depth of each of the steps and understand it in depth. Now I understand by the end of this revision, you will become well equipped to understand and prepare a console SOFP question with all the adjustments, okay. So now step number one is, first of all, try to understand and identify these three important data in your question of console SOFP. What are the three important data? One, what is the percentage acquired? So what is the percentage of shares acquired by parent in the subsidiary? Okay. Second, what is the date of acquisition? Third, what is the reporting date? So first of all, identify these three important data. Now, as part of second step, rectify investments. Now, what do you mean by rectification of investments? So many times what happens, the question is given something like this. I'm telling you, you should try to recall. Question says that parent has acquired 80% shares of subsidiary, and to acquire those subsidiaries, parent has paid $10 million cash to $10 million cash. Additionally, parent has promised to pay $12 million cash after a period of 3 years. Additionally, parent has also issued equity shares of its own company in the exchange ratio of 2:3. Means for every 3 shares acquired, parent is issuing 2 shares of its own. Now, towards the end, the question will say, parent has accounted for only cash consideration, meaning thereby parent has not yet accounted for the deferred consideration, and parent has not yet accounted for the shares exchange. So the investment value that is coming up in the parent books is not correct. So we have to first of all rectify the investments. Okay. Now as part of step 3, preparation of allocation of net assets pre-post. So what is the meaning of allocation of net assets? So basically we evaluate what is the fair value of net assets of subsidiary on the date of acquisition. What is the fair value of net assets of subsidiary on date of acquisition? When I say fair value of net assets, I mean to say all the assets and liabilities of subsidiary acquired at their fair values, even if there are some assets or liabilities which were not recognized in the SOFP of subsidiary but can be recognized in the group FS, even they are required to be recognized at their fair values. Sir, can you give an example? Yes, brand name, customer list, publishing titles, right? They will also be recognized at their fair values. For example, contingent liability, indemnification asset, they can also be recognized at their fair values on date of acquisition. Okay, now what is the change in the net assets from date of acquisition till reporting date, which gives us what is the profit earned by subsidiary. What is the profit earned by subsidiary from date of acquisition till reporting date? Okay, now understand please. So we have calculated as part of allocation of net assets, we have calculated two things. One, the fair value of net assets on date of acquisition. Two, what is the post acquisition profits of subsidiary from date of acquisition till reporting date? How are we going to use this data? Now, point number one, fair value of net assets on date of acquisition. We will use this data to compute goodwill or gain on bargain purchase. Okay, now the post acquisition profits of subsidiary earned from date of acquisition till reporting date will be allocated to parent and NCI in the ratio of their shareholding. Okay, now step number 4, calculate NCI on date of acquisition. So NCI can be calculated at proportionate share method or fair value method. So we'll understand how to calculate NCI at proportionate share method or fair value method. Now, step number 5, calculate goodwill on date of acquisition. So how do you calculate goodwill on date of acquisition? For example, so to calculate goodwill on date of acquisition, we will need investments, we will need value of NCI on date of acquisition, we'll need fair value of net assets on date of acquisition, that is calculated as part of step number 3. Right? Now, as part of step number 6, we have to compute that at each reporting date, what is the value of goodwill, what is the value of NCI, what is the value of consolidated other equity. Now, tell me, we have already computed goodwill on date of acquisition. Do we need to compute goodwill on reporting date? Will goodwill change from date of acquisition to reporting date? Ideally, no, but goodwill changes from date of acquisition to reporting date due to impairment of goodwill, and there cannot be any other reason for change of goodwill. Okay, now we have already calculated NCI on date of acquisition. Do we need to calculate NCI again? Yes, NCI will change. Why? Because we have to take the post acquisition share of profits of NCI that will be adjusted with NCI, and there are other adjustments also to NCI. So NCI changes from date of acquisition to reporting date. Okay, now as part of last step, you have to prepare the consol SOFP. So this is a helicopter view of how do we prepare the consol SOFP, and I will strongly recommend you guys to follow the same set of steps in the exam as well to prepare a consol SOFP. Okay, now coming to the adjustments. Now, working note number 1, allocation of net assets of subsidiary. How do you prepare this allocation of net assets of subsidiary? So please be very careful. Listen to each and every word that I say, because each and every word will be very helpful. So be very careful when you are listening to me. Okay, so first point is equity capital. Now tell me, this allocation of net assets is of which company? Parent or subsidiary? Subsidiary. Equity capital. Okay, so now equity capital on date of acquisition and reporting date ideally will be the same, unless question specifically mentions that the subsidiary issues any new shares. Okay, then retained earnings on date of acquisition will be given in the question, on reporting date will be given in the question. Now tell me, understand one thing, the retained earnings from date of acquisition to reporting date. So this balancing figure This will be balancing figure. So this balancing figure is called as what? It is called as post acquisition profits. It is called as post acquisition profits. Now understand. Question might say that subsidiary has paid a dividend in the post acquisition period. If subsidiary pays dividend in the post acquisition period, so what is the journal entry which subsidiary will pass? RE account debit to bank, retained earnings account debit to bank, right? Means that means this figure would have decreased due to dividend. This figure would have decreased due to dividend, right? But here we need the actual. Here we need the actual figure of post acquisition profits. To arrive at the actual figure of post acquisition profits, we need to add dividend paid by subsidiary. We need to add dividend paid by subsidiary. We need to add dividend paid by subsidiary. Okay, now. So now these two cumulative will give us the amount of post acquisition profits. Okay, now if question is of an information which says that the subsidiary was acquired in the mid of the year. Understand. This is, let's suppose, 1st April 20x1. Okay, this is, let's suppose, 31st March x2. Okay, so now subsidiary was acquired. Sorry, this this is, let's suppose, 1st of October. 1st October 20x1. Okay, so now, and the year starting date, the start date of the year is 1st April 20x1. 1st April 20x1. If the start of the year is 1st April 20x1. Okay, so now what you have to do, you have to do some time adjustments. Basically, I'm trying to say, if it's a mid-year acquisition, then you have to do time adjustment here. Okay, so here you have to do time adjustment. So from here you have to remove, and from here you have to add. Okay, so this will give you the carrying amount of net assets of subsidiary. This will give you carrying amount of net assets of subsidiary. Now you have to start doing fair value adjustment. Because you remember, we have to acquire the assets and liabilities of subsidiary at their fair values. So carrying amount is already here. So now are we required to adjust for the entire fair value? No. Let's suppose carrying amount is 100, fair value is 110. So here, as part of fair value adjustment, we will adjust only for the 10, the excess of fair value over and above the carrying amount. Fair value adjustment of property, plant and equipment. Okay, now understand, if we are increasing the value of asset, we need to increase the value of depreciation. So excess depreciation on fair value adjustment. So this will account for here. But since we are charging excess depreciation, it will reduce post acquisition profits. How to compute excess depreciation? It will be fair value adjustment divided by remaining life on date of acquisition, multiply by whatever is the post acquisition period. Okay. Now we can increase the font size, decrease the font size here. Okay, done. Now comes the next part, is fair value adjustment of inventory. Add it up here. Okay, now if this inventory gets sold in the post acquisition period, we have to reverse the fair value adjustment of inventory to the extent this inventory is sold. Okay, so now reversal of fair value adjustment on inventory. To the extent inventory is sold in post period. Okay, now you will see in the exam a note given in the question. Assume that inventory is not sold in the post period. If the question gives you this note that assume that inventory is not sold in the post period, then will we do this adjustment? No, we will not do this adjustment in that case. If question clearly says that inventory is not sold in the post period. Okay, now, so this is fair value adjustment on inventory. Now comes the next part, that is fair value adjustment. Sorry. Of trade payables. Of trade payables. Okay. Then we will, since trade payable is a liability, so it will decrease the net assets. It will decrease the net assets. Okay. Now, then further, brand name, then customer lists. Okay. Customer lists. So if there is any brand name, yes, brand name will have to be recognized at its fair value. At its fair value. Now, if we are recognizing the brand name, we have to amortize the brand name also. Amortize brand name. Amortize brand name. How to amortize brand name? So what is the fair value of brand name on date of acquisition divided by what is the remaining life? Okay, so this is how we amortize brand name. Similarly for customer lists also. So this is how. Now further, what other adjustments? What other adjustments? Unrealized profit. What other adjustments? Unrealized profit. Unrealized profits. Sorry. Unrealized profit. Now, unrealized profit are of two types. One is from subsidiary to parent, and another is parent to subsidiary. Another is parent to subsidiary. Comes the question, will we adjust both here? The answer is no. Understand, please. If the unrealized profit has happened from subsidiary to parent, tell me who has sold to whom? Subsidiary has sold to parent. The intra-group trading has happened between subsidiary and parent, and subsidiary has sold the goods to parent. So who has earned the profit? Subsidiary. So whose profit I have to reverse? Subsidiary. So here I will reverse the profit of subsidiary here. Here I will reverse the profit of subsidiary here. Now, if unrealized profit has happened from parent to subsidiary, meaning thereby parent has sold the goods to subsidiary. So who has earned the profit? Parent. So whose profit I have to reverse? Parent. But is it the net assets of parent? No, it's the net assets of subsidiary. So will I reduce this? No, I will not be expected to reduce this. I will not be. So you can remove it off. You can remove it off. Strike. Sorry. You can remove it off. Okay. But the question comes a question, where will you adjust? Then comes the question, where will you adjust the unrealized profit from parent to subsidiary? Where will you adjust? Adjust in consol RE, because that's the profit of parent. That's the profit of parent. Okay. Now done. Okay. Anything else? No, that's all. So this gives you fair value of net assets. This gives you fair value of net assets. Now, how to treat it? How to treat it? So please understand, guys. Now, this figure will be used to compute goodwill or gain on bargain purchase. Now, this figure will be allocated to parent and NCI in the ratio of their holding. Okay, red. Guys, tell me, is it clear to you? Is it clear to you? Okay, guys, this is the same format which you have to use in the exam. Okay, I am taking an exhaustive list. Might be in the exam you will see only PPE adjustment is there, trade payables, all these are not there. Okay, but I am trying to take up exhaustive, and I can assure you that nothing can come outside this. Nothing can come outside this. I'm trying to take up everything, whatever is possible. I am discussing it here. Everything, whatever is possible, I'm trying to discuss it here. Okay, now let's move further. Let's move further. So now understand, as part of our steps, we discussed this one, we discussed this one, we discussed this one. Now the next is calculate NCI on date of acquisition. How to compute NCI on date of acquisition? So NCI on date of acquisition can be computed using two methods, at proportionate share method or at fair value method. Okay, now if question is silent, we will use proportionate share method. If question clearly mentions the use of fair value method, it is then only we will use fair value method. Now comes the question, under both the methods, which how to compute? So if it is proportionate share of net assets, then we'll take fair value of net assets on date of acquisition. This one, the same, this one. I'm talking about this one, okay? Multiplied by NCI percentage. This is what is the value of NCI under proportionate share of net assets method, okay? Now, if it is fair value method, then fair value of NCI on date of acquisition will be given in question. It will be given in the question. It will be given in the question. It will be given in the question. Sir, what if not given? What if not given? Arey, don't worry, I am here. I am here. No, don't worry, I am here. If not given, then see what is the number of shares. What is the number of shares held by NCI? So let's suppose subsidiary has a total number of shares of 100,000. Parent owns 80%. Parent owns 80% means NCI holds 20%, means NCI holds 20% of 100,000 means NCI holds 20,000 shares, multiplied by what is the fair value per share of subsidiary. So this will give you the fair value of NCI. This will give you the fair value of NCI. Sorry. Clear everyone? Is it clear everyone? Now moving on to how to compute goodwill. How to compute goodwill. Okay, goodwill or gain on bargain purchase. Goodwill or gain on bargain purchase. How to compute that? Okay, so let us discuss now. So first of all, I will take up investments on date of what is the value of investments? What is the value of investments? Okay, then we will need what is the value of NCI? NCI on date of acquisition less what is the fair value of net assets on date of acquisition? See, I told no fair value of net assets on date of acquisition. We will need this figure to compute goodwill or gain on bargain purchase. See, here we used. So this will give you the value of goodwill on date of acquisition. This will give you the goodwill on date of acquisition. Okay, goodwill on date of acquisition. Now, from goodwill on date of acquisition, okay, so please try to understand, guys. Please try to understand this figure. If positive, this figure, if positive, is your goodwill. This figure, if positive, is your goodwill. Okay, this figure, if negative, is your gain on bargain purchase. Now, if it is goodwill, we report it in SOFP. If it is GBP, we report it in, we add this to console RE. We add this to console RE. Okay, I believe it is very much clear to all of you. Now, further, less, if it is goodwill, goodwill can get impaired subsequently. So I'm writing here less goodwill impairment, goodwill impairment. So if the goodwill is impaired, we have to account for that. Now this figure will give you, now if we have to, sorry, copy, this figure will come goodwill on reporting date, goodwill on reporting date. This is the figure which will report in SOFP. This is the figure which will report in SOFP. Okay, now comes the treatment of goodwill impairment. What is the treatment of goodwill impairment? Now, since this is a question of console SOFP, I'll talk from that perspective. Okay, now if NCI is a proportionate share method, reduce goodwill, reduce goodwill, reduce console RE. Simple. If NCI is at fair value method, then I will say reduce goodwill, reduce console RE and NCI in the ratio of their shareholding. Is it clear, everyone? Come on, guys, tell me. Is it clear, everyone? So basically, if NCI is at proportionate share method, we take the impact of goodwill impairment to console RE. But if NCI is at fair value method, we take the impact to console RE and NCI. Okay. So now let me take up an example and explain. Okay, so let's suppose the goodwill impairment is by $100. Okay, so in this case, what we'll do, goodwill minus 100, then console RE minus 100. Okay. Now, but similarly, if NCI is at fair value method, then what will happen? If goodwill is impaired by 100 and the parent holds 80%, then console RE by 80 and NCI will reduce by 20. I believe it is clear to all of you. Are you understanding the treatment of goodwill impairment? Okay, so please see what is happening here. We discussed step 1, we discussed step 2, we discussed step 3, we discussed step 4, we discussed step 5. Now we calculate goodwill on reporting date. This is what we are doing. I believe it is clear to all of you till now. Okay, now comes the next part. Console RE on reporting date. How to compute console RE on reporting date? Okay, so let us prepare console RE now. Okay, console RE. So first of all, as part of console RE, we take what? We take parents RE on reporting date. What is the balance of parents RE on reporting date? We take that figure directly, no adjustment, nothing. We directly take the value of parents RE on reporting date. Then we add what? Post acquisition profit of subsidiary, parents share okay, then what? Add, then what? Come on, guys, tell me. Add, come on, guys, tell me what? If subsidiary has paid some dividend, parent would have recognized that as an income, but when we're preparing group FS, we have to eliminate the dividend, right? So less dividend from subsi, from S, parents share, okay. Now close, dividend. Okay. Now what else? Add gain on bargain purchase. Gain on bargain purchase. Right? If it was a goodwill, we would have reported in face of SOFP. But if it is gain on bargain purchase, we have to add to console RE. We have to add to console RE. Then what else? Less unrealized profit. Parent to S and subsidiary to parent. Now tell me which one will be adjusted here. If parent has sold the goods to subsidiary, who has earned the profit? Parent. So whose profit shall I reduce? Parent. So shall I adjust it here? Yes, it will be adjusted here. It will be adjusted here. It will be adjusted here. Okay. Now, but if subsidiary has sold the goods to parent, it will reduce we have to reduce the profit of subsidiary. Will we adjust here? No. See, this part S to P was adjusted here. S to P was adjusted here. S to P was adjusted here. P to S was not adjusted. Adjust in console RE. C, we adjusted in console RE P to S. So this part will not be adjusted here. Strike through. Is it clear, everyone? Is it clear, everyone? Now what else? So now goodwill impairment. Less. Goodwill impairment. Goodwill impairment. We have to adjust here. Okay. So this will give you the value of consolidated RE on reporting date. I believe it is clear to all of you. Now we have to compute one more data. We have to compute one more thing. We have to compute one more thing. NCI. We have to compute NCI. NCI on reporting date. NCI on reporting date. NCI on reporting date. Okay. Now, so first of all, we have to compute what is the value of NCI on date of acquisition. Okay. Now it can be as per proportionate share method, or it can be as per fair value method. Anything it can be. Okay. So we will take this figure as it is. Then we will take what? This one. Parent's share of, here it will take NCI share. We'll take NCI's share. We'll take NCI's share here. Okay. NCI share of post-acquisition profit. See, I told here. See, just see here. Please see. Let me highlight these two parts. Now, see here. I told the post-acquisition profit. The post-acquisition profit will be allocated to P and NCI in the ratio of their holding. See, that's what I did. Post-acquisition profit P share to console RE, NCI share to NCI. Right? Now, dividend received from subsidiary. Parent's share has to be reduced from console RE. NCI share has to be reduced from NCI. NCI share has to be reduced from NCI. Okay. Now, what else? What else? Less goodwill impairment. Goodwill impairment. But there is a point. There is a point. If NCI is at fair value method, because if NCI is at proportionate share method, will we recognize goodwill impairment with NCI? Will we recognize goodwill impairment with NCI? No, right? So only if only if NCI is at fair value method, we recognize the goodwill impairment in NCI as well. Okay, so this is also clear. I believe this part clear to all of you? Is this part clear to all of you? Now, total. So this will give you the value of NCI on reporting date. I hope it is clear to all of you. Now comes the last step, that is console SOFP. Are you ready for it? Come on guys, tell me. Are you ready for it? Okay, let us start it. Okay, let's start it. Now let us start preparing console SOFP. Coming to PPE. So what will you write? The balance of PPE of parent on the reporting date plus that of subsidiary on the reporting date, okay, plus fair value adjustment, plus fair value adjustment that we did on date of acquisition, right, minus excess depreciation on fair value adjustment. This is what will be reported under PPE, right? Now, what is the value of goodwill that you report? So goodwill we have computed. Goodwill we have computed. Working note number what? Working note number what? This one, goodwill. Working note number 3. Goodwill is working note number 3. Goodwill we have computed. Right? Now, inventory. What is the adjustment with inventory? A good point. A very good point. Please listen to me carefully, guys. Please listen to me carefully. First of all, inventory of parent plus subsidiary. Okay, then what? Plus fair value adjustment on date of acquisition minus what? Reversal of fair value adjustment to the extent the inventory is sold in post period. Okay, now what else? Minus unrealized profit. Minus unrealized profit. Okay, it can be P to S or it can be S to P, irrespective of that, to the extent inventory is unsold. There is a difference between reversal of fair value adjustment and unrealized profit. Plus goods in transit. In case of contra, you remember, in case of contra, the parent has sold the goods to subsidiary, but subsidiary has not received the goods by reporting date. So there comes a point of goods in transit. So we have to add the goods in transit to inventory. So if we are adding goods in transit, we have to minus the unrealized profit on goods in transit also, we have to minus. So then you will get the figure of inventory. Might definitely guys, in the exam you will not get all the adjustments in the same question, but I am trying to discuss all the possible cases so that nothing can come outside this. Okay, now trade receivable, parent plus subsidiary minus contra. Okay, cash no adjustment, only parent plus subsidiary I can write here very well. Parent plus subsidiary. Okay, now equity share capital. Will we write parent plus subsidiary? No, only parent. But here we will add new shares issued by parent for purchase consideration. Now, so this is as part of rectification of investments. So basically, you remember today itself I was discussing at the very beginning that let's suppose parent has issued its own shares but not accounted for it. So as part of rectification of investments, we have to account for it. So what is the journal entry? We will increase investments account debit to equity share capital to securities premium, right? So again, for share premium also I will write the same. Okay, so but now understand, how will you understand what amount will go to equity capital and what amount will go to share premium? So understand, so for this you have to write number of shares issued multiply by face value will come to equity share capital. Okay, then number of shares issued multiplied by fair value minus face value. So let's suppose the value at which the shares were issued was $3 per share, but the face value is 1 per share. So we will increase equity share capital by 1 per share, and will increase securities premium or share premium by 2 per share. So 1 will be here, 2 will be here. Okay, any amount over and above the face value is called a securities premium, share premium. Okay, now retained earnings, we have prepared the working note. Retained earnings, we have prepared the working note. Working note number are not sequenced in properly. Kya? Let me just sequence working note number 1. Just a minute. Okay, I have sequenced the working note numbers. So now retained earnings is working note number 5. Working note number 5. So retained earnings we have completed working note number 5. Now coming to non-controlling interest. This also we have computed. What is the working note number? Working note number 6. Now coming to non-current liabilities. Non-current liabilities. Now under non-current liabilities, what will come? Under non-current liabilities, what will come? So right, see here, parent plus subsidiary. Now plus, okay, deferred consideration plus deferred consideration on date of acquisition at present value, if this was not accounted for as part of rectification of investments, okay. So now what is journal entry? Investments account debit to deferred consideration, and as I mentioned, deferred consideration is a financial liability as part of non-current liabilities. Okay, non-current liabilities, or it can be current liability also if it is to be paid within you can say within 12 months, okay, from the end of the reporting date. Now further, what will happen also? If we have deferred consideration at present value on date of acquisition, then we will also have the unwinding finance costs. Unwinding finance costs on deferred consideration. What is the treatment of unwinding finance costs? Okay, so it is consol RE account debit to deferred consideration. Oh, so means we have to adjust this finance cost in consol RE. Yes. So let's adjust. Add, sorry, less, not add, less. It's an expense. Less finance costs on deferred consideration. Now, if we have finance cost on deferred consideration, similarly, we can also have something called as, tell me, can you please tell me? The small brother of deferred consideration is what? Fair value gain or loss on contingent consideration, right? Contingent consideration, right? So this can also come up, right? Similarly here. So you can write here. Let's write here. Under non-current liabilities, it can be a fair value of contingent consideration on date of acquisition plus fair value change on contingent consideration. So this is also to be accounted for, right? So let us account that here. So this will give you the value of non-current liabilities. But be mindful, guys, in the exam that this deferred consideration or contingent consideration, is it a non-current liability or a current liability? If it is to be paid within 1 year, current. If it is to be paid beyond 1 year from the end of reporting date, then it's a non-current. Now, what will come under current liabilities? Parent plus subsidiary minus contra. Just one thing that I missed, guys, in cash, it will be parent plus subsidiary plus cash in transit. What is the meaning of cash in transit? Parent has sent cash to subsidiary, but subsidiary has not received that cash by end of reporting date. So that is called as cash in transit. So this completes your consol SOFP. Tell me, guys, does this give you confidence on consol SOFP?